All right, everybody, let's try take two. I recognize that I've situated the mic a little bit differently this time than I have in previous. So the mic was running a little bit hot, but we're talking today about year-end 2023 dividend income, options income. Today is December 29th. And obviously we're talking about this because it is the last trading day of the year, and we are fortunate to have a phenomenal year with respect to all of our speculative investments, as well as just continued chugging along in the investing opportunity that we have here on, I mostly take advantage of Fidelity and things of the like. But dividend income actually year over year had a decrease. So we'll get into a reason why of that. And we'll look at what companies paid me in 2022 versus what companies paid me in 2023 and understand a little bit why some of the year over year changes associated with that. And then we'll get into a potential forecast for next year, which we're going to see another 10% decline in the dividend income. And there's a good reason for that. And I think we'll be able to look specifically at what companies or stocks or ETFs were divested from the current portfolio to be able to get to that point. We'll also see a little bit about YouTube income for the year. Now, of course, that since the August-ish timeframe has all been put into a public investment fund for Cash Flow Chronicles. And so with that, you have the opportunity to look at it and be able to understand what is in that portfolio. So for those of you guys that are interested in keeping up with Cash Flow Chronicles, we have a whole backlog of opportunities starting from our very first show that we did in the August timeframe about Google, and we have a bunch of upcoming ones in here as well. And I think we'll be out to like the mid-January timeframe, and then we have a bunch that I'll probably do double releases. Like tomorrow, I think there's going to be 3 releases in total, so it could be an opportunity for you to catch up. Tomorrow's going to be talking about Alexa. I think it's also going to be talking about Rocket Lab, Disney, and I forget what the other opportunity was. I think it was just one of the more recent podcasts that me and Chris had talked about. So far, 395 of you guys have moved over to that channel. It's where eventually Chris and I will be moving over to eventually, just to kind of keep financials separate and easier to track. But that being said, I'll leave the description in the link for this in the description, and you guys can go ahead and check that out. So looking specifically into this, now let me zoom in because I know it's a little bit difficult, specifically when you're looking on a phone, to be able to see these things. Now, 200% is a little bit too much. So let's take it to 150. But this is 2023. For those of you guys that haven't seen this table before, I have months all the way on the left here. And then I have ticker symbols and maybe some categories here on the top. Red means it's an affirmed, calculated number. Black means it's either no payment or has not been verified if there is a number there. So keep in mind, I have all of this tracked out until 2020 or 2013. One day, I plan on getting everything in here. I used to just do it on a manual Excel workbook, but then I moved it to Google Sheets because it's a little bit easier and you can track it on your phone and stuff like that, and input things on your phone, mobile device, rather than having to do it on a desktop or laptop. So makes things a little bit easier. So overall, pretty good, right? Income overall with options income, YouTube, etc., dividends, 42,000, which is pretty good. 22,000 of which was from dividends. And you had a really good month in December for options income, but keep in mind, this was a lot of rolling over and stuff like that. So January, not rolling over because it needed to be, just because we were pushing things out to the February timeframe, get that extra theta decay. So we might end up in a negative for January 2024. So I generally do a mark to market for this one. This is just all the premium I've received. And so therefore, January timeframe, I might have to buy back a bunch of stuff at a loss. Who the hell knows? But for now, the amount of premium I received in the fiscal year 2023 was about just under 18,000. And then YouTube, I made about $200 a month, about, give or take. So with that, overall, 42,000, not bad. How did that compare to last year? So it's up from last year. And I think a lot of that could be, I didn't really check or do a lot of options in the second half of 2022. I might have to go back and update this, but in terms of dividend income, we made about 26,000 in dividend income. So we're down over 10%. And we'll get into specifics as to why that is when we get into more of this monthly dividend analysis piece. But for now, let's just hop over and see what companies paid us and what amount and how much it was up year over year. So SOXL is a rather small position that just paid $6.34 specifically in December. It's my traditional IRA. Then you have BlackRock, which paid us about $206. That's $31 more than last year, which is pretty cool to be able to see that dividend increases there. I sold out a Caterpillar, so compared to last year, it looks like I had about 4 quarters worth of Caterpillar payments, and I sold out a Caterpillar. With the Inflation Reduction Act, it was just too good to pass up. It was in like the 220, 230 range, and my cost base was around $110. So it made sense to just take that money and likely put it in the S&P 500, and it's been doing well thus far. Then you have Devo. That's just like a monthly dividend ETF. And I don't know if I've shrunk. I think every once in a while I'll like trim a little bit and put it into the S&P 500. But for now, it's just been hanging out, $1,800, so it's about $150-ish, give or take, every single month associated with that. JEPI I cut, so I ended up being down a pretty significant amount. And I also think I was trimming throughout the year, so I think I grew this up to the point where it was almost getting closer to $500 a month, and then earlier this year I trimmed it, and then I fully eliminated it from the portfolio. I moved a lot of that into the S&P 500. I think some of it moved to Nextera as well, which we'll get into in just a moment. So that was down $1,600 year over year. J&J is another one that I cut. That would have been up had I been able to keep on to that portfolio, but I think just continue to consolidate while I have the opportunity. J&J, not a bad company, but I just realized, like, if I'm going to move and transition more towards long-term appreciative growth and balanced growth, J&J is probably not the company that I want to hold. And so eventually, maybe in the long term, if I get closer to, being financially independent and have several $1 million on the side, maybe I have strictly a dividend portfolio and low volatility portfolio, maybe J&J will come back. But for now, it just didn't make any sense to hold on to it for now. Nextera Energy, you can see this is the first dividend payment here. So that was 236 bones that was able to come into the portfolio. Altria Group, no payments this year. That is a decrease of about $1,900 comparatively to last year. So that was a pretty good dividend payer, just under $500 every quarter for that one. O Realty was another one that got cold, and some of that money went into some of the Nextera position or S&P 500 as well, and maybe some additional Palantir sales or something, or buys rather, throughout the year. So there was that piece. It was generating about $125 a month. So sad to see it go. It was a good opportunity in the portfolio. I just don't necessarily see it doubling or tripling from here versus some of the other opportunities that are out there. So even though I made $1,100, because I cut it 3 months early, I ended up making $275 less in 2023 comparatively to 2024. Then you have Pepsi. Pepsi is a great one. I like Pepsi. I've also slightly trimmed that one as well. So the forward, you can see the payments are only going to be $189 versus the $250, $260 or so that they were kind of getting to. So that being said, made about $87 more. Next year, it should be about $250 less. So unless I cut it all, which is a possibility, put that into the S&P 500 or maybe consolidate into some other companies in there as well. Then you had Royal Dutch Shell, or now just called Shell, I guess, SHEL. This is the old ticker symbol here. That one continues to be reinvested. We're at over $2,000 a year in this one. And that's a $469 increase year over year. And that should increase to $2,200 next year. So about $200 increase comparatively. And that'll grow with dividend reinvestment as well, unless there's some sort of dividend cut. SPY, this one was one, like I said, that I continued to grow into. Last year, I made about $900 in dividends from SPY. This one, I'm over $500 a quarter. So about $2,100 this year alone in SPY. So it's a $1,200 increase year over year. So over 100% increase in the dividends that I received from SPY. Probably closer to 125% increase there. This says I'm going to be making $800 a quarter. I got to check the math on this, to be very honest with you guys. So I'll check, but it says right now $3,200. So I don't know if I just miscalculated that or what have you. And I know I did add over the last few last few months as well. So maybe that's what it is. But I find it very hard to believe that we go from a $550 to $533 payment all the way to $800 or so. I could see $600 or $650, but so we'll see. It should come in the January timeframe. Stag Industrial, another great one, about $85 a month at this point. So that was an increase. So just under 1,000 bones for this one, $56 increase year over year from 2022. We should be getting closer to 1,015 next year, so an increase of about 23. This is without any further dividend increase or dividend growth assumed in here. So just with the 84.58, pretty good. But either way, this one's a pretty good pair. Just because I reinvest all my dividends, I get about 30 cents more per quarter, per month every time I reinvest. So it should go to about 84.80 next time. 84.90 next time. So, and then it'll just keep growing 30 cents at a time. So you can't complain with that kind of growth. But at the same time, it's like, should you invest in something like a Stag or just keep it in the S&P 500 and let it do its thing? Stag is doing relatively well. It's a supporter of Amazon with respect to the warehousing industry. So, it's hard to let something like that go. But if I see some sort of physical real estate or anything of the like, that $25-ish thousand could be helped to be used in a down payment situation, and the long-term equity growth that I could get with, say, physical real estate might be something that's more enticing and I can grow into for the long term than, say, this $80 or $90 a month that I can generate with it. So I don't know. We'll see. Because you think about it, if you're able to stack this up with a couple things of one or two of these positions, 2 or 3 $25,000 positions, and you have a piece of property that's going to appreciate with growth, and then the equity pay down, and that alone, it starts to get you thinking a little bit. Then you have the triple leverage NASDAQ 100, TQQQ. That position's been pretty big, but it continues to grow. Had $162 payment growth over last year, about $850 in dividends associated with that. I have like 1,300 shares of TQQQ, so that one's not too surprising there. Some things that I trimmed here. I used to have Exxon. That's a pretty good company that unfortunately I just saw the writing on the wall. I might have trimmed it a little too early. But loss of $650 in terms of dividend income there. And then you have XYLD, which is a S&P 500 covered call ETF. That was trimmed as well, and that was a $1,200 loss in terms of dividend income there, and so be it. Then you have XYLG, which is more of like a 50% covered call ETF, so invest mostly in the S&P 500, but 50% of the S&P 500 is then written covered calls on. So you're still able to get some of the upside of it rather than consistently capping your upside, but you're also getting a slight increase in the option income that's coming from that. So can't complain with this one. I think it's pretty good, but I did trim some of it, I think, to just consolidate more. And I'm trying to get the dividend yield of the portfolio down between 2 and 2.5%, which I've been successful for. So that was just part of the culling there. And this one I might decide to either fully eliminate or just kind of keep at a little bit of a percentage. But for right now, I'm not really focusing on the dividends per se. But this one might be one I come back for because I really did truly like the partly growth, partly dividend aspect of this. It gets you a 4 or 5% dividend yield, and you're not really capping your upside. So I really truly enjoyed that piece of it. It's just for right now, I'm not really focusing on the dividend income per se. BHP, this is a 400% returner in my portfolio. I wish I had more shares, but I think my cost base is around $2,200. So the fact that I'm getting 600 bones a year is great. That's still down, though, I think because we had some special dividends in the last year, and then even in 2021, there was more special dividends. So you can see here, it's down $500 last year, and it's even down another $400 this year. And I think it's just all the special dividends that they were paying as they were focusing their portfolio, getting out of petroleum assets. And then this year, I think alone, the commodities prices is not nearly as good as what it was last year. And they have a variable dividend payment semi-annual. So I think that they give out 40% of excess cash flow, towards people, which I kind of like and I kind of dislike, right? You can't really count on the consistency piece, which is a problem. But at the same time, if a company's not making money, I don't expect them to be paying out and going into debt in order to pay me. So kind of plus or minus there. JEPI, another one in here. This is in the Roth IRA. I think I might have just continued to slightly trim this one to buy other opportunities and get other things up to like 200 shares or 300 shares or something of the like. Some of which being SLG. But you can see, I think we were originally running like 100, 123, and I think I trimmed it a little bit just to be able to. So we're down about 120 bucks for the year on that one, but that one's still pulled in just under 100 bucks a month overall in the Roth, which is pretty cool. And that's kind of a slush fund. Like if I find something really good that I want to buy into, I probably will. SLG, this is a new one to the portfolio in 2023, so $643 in fresh capital there, so that's cool. TQQQ was something I bought in last year in the portfolio, so this one was actually probably well timed, but the dividends started kind of coming in here. And can't complain about that one. I didn't receive a dividend as of yet. I think the dividends will come in. No, that's a lie. I feel like I did get dividends in TQQQ. So I might have to double check if I missed a little bit there. But it might be, off by 30 bucks or so. So it's not a big deal. Then you have Woodside. This one increased, I think, because this was a spinoff of BHP last year. So yeah, this also has a variable dividend. So this was a newer income stream as well. WP Carry was cut, so we did have 430 bucks, and I cut this before it really drastically dropped. I think I sold it at $85 or $90, and then earlier this year it really took a hit. It actually cut the dividend, so good timing for me. I did like this one. It's a triple net lease, but at the same time, just with rising interest rates, I just saw the writing on the wall, and I wanted to get out of some of the other REITs that were exposed. So this one was one of them that got culled. Lost $211 in terms of dividend income there, but good choice in capital preservation by me. And maybe if it rebounds or something like that, I might get into it in the future. But right now, not really focusing too much on the dividend income. And one of my oldest positions that I never grew, WTRG. This is in my computer shares portfolio, investing directly with the company there. You have Keurig Dr. Pepper here. You have some Philip Morris, $37 or so. You have some Fundrise. Yes, I invest in Fundrise. You can check out some of those videos on the channel itself, where I talk specifically about how much money I'm putting in. I think it's about 135 or 150 bucks a month. And this has grown to about a $14,000 position, and it's throwing off about 100 bucks, 120 bucks every quarter or so. And the hope is to eventually get it to closer to like 1,000. But at the same time, if I'm going to get into physical real estate, I might just take this 14 grand, couple it with the Stag Industrial position. You have close to 40 grand right there to put into a down payment on something. So if I get a bonus or stack some paper for a couple months, it could be used to buy some physical real estate, whether it's a beach house, do some more Airbnbs, who knows, right? Because in a couple years' time, that Airbnb will generate enough capital to be able to purchase another property, and that's another story for a different day. You have some shares through work. We won't talk about that, but that has expanded pretty extensively to just about $3,000 in shares there. Then you have Cardone Equity Fund 5. We've seen some increases throughout the year. So I don't actually reinvest this because it's hard to, because it's actual physical real estate, but I get the checks directly to my checking account every single month. And it went from just under 60 bucks to now just under $65, just over $65. So an increase of 84 bucks year over year, 750 bucks. So just over 5% dividend on my initial 15% investment. So, and I think that the actual investment itself is close to like a $30,000–$35,000. So we've actually seen a 100% return. Granted, that could shrink if real estate prices decrease, but there it is. I was storing a lot of capital in my American Express savings for the first half of the year into the second half of the year to get the down payment on the house. So I made about $520 in interest payments on there. And obviously that's gone away because I purchased the house and now I'm living in the house. So there it is, right? So I think I closed on October 20th. And so with that, here is no more. I'm starting to recuperate that a little bit. So maybe in the coming months, this will increase again. But 520 bones, and that was something that was, there wasn't really much in there last year. So I know I was trying to do some in 2020, and then I cleared it out because there wasn't much. And then once the interest rates started to rise up again, and I was saving for the house, it just made sense to put it in the Amex personal savings. So there's that. There's all the companies and all the decreases in the portfolio that you're kind of seeing. Once again, just over $22,000 worth of dividend payments. I do have the options income in here. It's about $17,000. It's all over the place, man. It's mostly Palantir, but I do some Amazon, I do some Google, do the SP 500, do some on TQQQ. But I don't write on everything, right? Because some things are there's like so much liquidity. Like Nextera is even hard, but like Realty Income, I wasn't really writing anything on. Stag Industrial, I don't. And so there's an opportunity to get out of some of those lower liquidity opportunities and put it into the SPY or put it into something that is higher liquidity, Amazon. But I'm not going to do that strictly for the options income, right? Like 17,000, that's great. I can't complain with that. So it's a percentage point or two return on the portfolio, but I'd rather invest in the right opportunities and then get the covered call income as slight, right? So options income here for me is the cherry on top. It's not the objective of the portfolio. So I'm not going to prioritize buying something because it has a higher liquidity if I think it's going to have inferior growth, right? I'd rather buy a Rocket Lab or something like that because of the capital appreciation I think it's going to have, or a Dutch Bros for the appreciation I think it's going to have, rather than specifically investing in something for the options income, right? Now, SPY has really good liquidity. It's one of the reasons why I invest in it rather than a VOO or IVV. Yes, it has a higher expense ratio, but at the end of the day, write a few cover calls on SPY, that expense ratio kind of goes away and is paid for off of that. So just looking to next year, what's going to happen, right? You heard me talking about trimming some positions. So next year, at the moment, we're looking at about $20,000 in dividend payments. So a 10% decrease. And I remember seeing this dividend total, and it was like going closer and closer to $3,000 a month. And this was, because we were at 25,000, and actually in 2023, before I started to trim some of this and really start moving more towards a long-term growth portfolio in 2023, there was actually a few $3,000 months in 2023. But since I've refocused the portfolio, it's gotten a little bit more choppy. So now, like the third month of every quarter might be large, but the second month is back below 1,000, which was really sad because I really wanted to get everything above $1,000 a month. And majority of 2022, I was able to achieve that. But anyway, you can see the portfolio in dividend growth went pretty extravagant. This is why I did the pivot in total. So a little sidebar on this, and we'll get back to it. And I don't have the 2019 numbers on here, but I think the 2019 numbers were like 11,000. 2020 was 15. 2021 was just under 23,000. And I actually have it on the monthly dividend analysis, which we'll get to in just a moment. Then it's close to 26,000, and then I think I was supposed to get close to 30,000 in 2023, and I was just like, it's just so much in taxes, and I could be investing this in a more efficient manner, investing in long-term growth. I don't need $30,000 in dividends, stuff like that. And I kind of made that pivot to focus a little bit more on the long-term appreciation piece, and now we're kind of staring down $20,000 for next year, so a slight decrease comparatively. But let's just look for what big changes. So Devo is about $100. Oh, so that's $1,100 loss for next year. Pepsi is about a $250 loss. Shell will be an increase. SPY, we're continuing to invest in that, so that's an increase. TQQQ is pretty variable. Who knows what we're going to end up with there. XYLG I've trimmed a little bit, so that makes sense. BHP, we're hoping just because of reinvestment. That's at $67 for reinvestment, but they could decrease the dividend even more next year. JETB, I think this is mostly from dividend reinvestment. SLG, I think this is a full year versus partial year. Woodside, I think that's just dividend reinvestment there. WP Carry, it's a loss of $200. That's probably just slight off. I think I haven't updated the share count of WTRG. So there's that. Yeah, Fundrise, that'll hopefully be good. And then we have the website savings piece, which I don't have as much in my personal savings. So there's probably another $500 that we're not going to get unless I get pretty aggressive with that piece. So overall, that's going to be a decrease of $2,200 in dividend income that I'm going to be receiving next year. Keep in mind, I reinvest the majority of these, so this will probably grow over time, but there's also an opportunity I sell Pepsi. There's an opportunity I sell Stag Industrial and invest it in something that doesn't pay as much of a dividend. And so there's an opportunity for this go to 18, 19,000 as the year progresses. But if I kind of keep the portfolio as is, there's an opportunity for this to grow. And I think we're going to hit a point where we sell out of some of these higher yielding opportunities. And eventually we kind of, as the portfolio grows, continue to kind of go up again. So let's just look at the dividend piece of it in the monthly analysis. Here's a kind of cool graph to be able to see how the months have grown. You can see that 2022 is probably the peak for a lot of these things. 2021, 2022. 2022 being these green opportunities or green bars throughout the month. So it's pretty cool. And here's the year-over-year growth, right? You can actually see, I don't know why 2022 is not showing up here, but that's a problem I got to fix. But 2023, you can actually see negative growth in a lot of these, which is kind of sad to see, but it is what it is. And then if you look specifically at it, we were growing very fast. The year-over-year growth. So 2019, I'm sorry, we didn't make 11,000. We made 9,000 in 2019, and then we went to 15, 22. So we were growing at a fast pace, 71% year-over-year growth from 2019 to 2020, 49% growth from 2020 to 2021. 2021 to 2022, we made about 12% growth, and that's when I started to focus a little bit more on the long-term appreciation piece. It was an opportunity when the market gave it to us, as the market pulled back in late 2021, 2022, you saw a lot of opportunities come out like Google and Amazon, and it allowed me to take some money out of some positions that I did really well in terms of dividend income and being able to put money and capital preserve in those opportunities and pivot and get myself into a firm foundation piece. And also Palantir was a really good price. So that opportunity to move into those opportunities at the right time was there. And so I took that opportunity. And then 2023 has just been a continuation and consolidation of some of those things. So you can see pretty drastic decrease. You can see the increase in some of the months, but majority of it being down, and it should be about 12% down year over year. But this is a cool graphic here. So there's the portfolio value over time, but this is kind of a cool graphic that I was working on with somebody the other day. It was like this is a trailing 12-month, this red line here. But you can see originally it was, and this is monthly dividends, right? So an average of that, you can see the volatility of it all. And it actually started spiking $3,000. I was like really excited to hopefully, get, and you could see how quickly and exponentially this thing was growing. And so you could kind of start to see from like a reason being as to why I switched up was like, I'm 32 years old. I don't need the money right now. I'm just going to be paying a crap ton of taxes on these dividends that I'm receiving. I'd rather reinvest a lot of that opportunity or just keep it in a tax advantaged way to continue that growth and only pay taxes or anything like that if I sell it. And so instead of increasing my tax obligation by probably $600, $700 a month with these dividends, as I would have to, 15, 20%, because a lot of this is out of tax advantage accounts, right? Some of it's in a Roth, but some of it's in an individual brokerage account. So And that's for flexibility reasons. If I want to transition to real estate, I want to transition to a business, I want to start a website, anything like that, I have that capability to do that and have that flexibility rather than it being locked up in a retirement account. So you start seeing me start to pull off the gas here in the 2022 timeframe to focus in more on the long-term growth, and you're actually seeing it. So I think what you're going to end up seeing is this is going to eventually level off, probably at the $1,500 a month range, and then it's going to start taking off again as the portfolio continues to grow and grow and grow, because there is going to be a piece of dividend growth as you reinvest in itself. So I think as the yield has come down, the portfolio is now yielding about 2.1% comparatively to 4 or 5% in the past. So there's that big decrease. And so you're seeing a decrease in the overall dividends, down from like $2,200 a month average down to closer to $1,700 a month average, maybe $1,800 a month average. But next month or next year, it'll be closer to $1,600, $1,700 a month. But I anticipate we're going to stay at that 20,000 maybe for the next year or two, and then it'll slowly start to climb up again. Because you think about it, 2% yield, $20,000 portfolio, you're going to be growing $400, $500 just from the dividend reinvestment and the dividend growth that's within the portfolio. And then if you're adding additional capital to the portfolio as well, so I anticipate you'll start to see this start to move back, not to the exponential growth that you were kind of seeing before, but a steady increase. And hopefully within the next 10 years or so, we can get back to that 30,000 a year mark, but it'll be a much healthier, sustainable piece. And that'll be really cool to be able to get $30,000 a year of dividend income at a 2%-ish portfolio for dividend yield. So that would be really cool. But that's pretty much it, my guys. And hopefully that finds you well. And it was a good video. I know it's probably way longer than you wanted to, but it's a year-end video. And I haven't covered a lot of the month-by-month opportunities as I used to. And so if you find this video very useful, be sure to let me know in the comment section, because I think a lot of people really like these videos in the past. And I think I haven't really been doing them as much in this year because I've been too busy doing, say, the podcasting piece or working, getting back up to speed with that, going back into the office. So it's a little bit more difficult to juggle being in the office back again, kind of almost full time, and continue to write these videos and get these videos out for you guys. But hopefully this is a good full year video for you. And looking forward to a great 2024, get close to $20,000 in income, and hopefully grow that YouTube income. So if you have that opportunity, once again, please check out Cashflow Chronicles. It'd be really useful for me and Chris to be able to get to that 1,000 subscriber mark and eventually transition our live streams over to there to help separate the difference between what's a Matt Money live stream and what's a Chris and Matt live stream for Cashflow Chronicles. And as always, much appreciated. Hope you guys have a phenomenal new year. And I will talk to you guys soon. Cheers and peace and love and good luck on your investing journey.